creation of money when there are many banks. Mary makes an initial deposit of $100 in Bank 1 and the bank deposits the entire $100 with the Fed. After Mary's deposit, Bank 1 can make a loan up to $80 to Bill because it needs to keep only $20 of its $100 deposit as reserve. In other words, Bank 1 has $80 in excess reserve. Bill then writes a check to Sam's car shop for $80 for a set of shock absorbers for his cars. And then Sam's car shop deposits Bill's check in Bank 2. When the check clears, Bank 1 transfers $80 in reserve to Bank 2. Bank 2 now has $80 in deposits and $80 in reserves. Its reserves requirement is also 20%, so it has excess reserve of $64 on which it can make loans. Now, assume that Bank 2 loans the $64 to Kate to pay for a textbook and Kate writes a check for $64 payable to the Manhattan College bookstore. The Manhattan College bookstore deposits Kate's check in its account with Bank 3. Bank 3 now has excess reserve because it has added $64 to its reserve. With a reserve ratio of 20%, Bank 3 can loan out $51.2, 80% of $64, leaving 20% in required reserves to back the $64 deposit. As the process is repeated over and over, total amount of deposits created is $500. The sum of deposits in each of the banks, because the banking system can be looked on as one big bank. The outcome here for many banks is the same as the outcome for one bank. Money multiplier is 1 per required reserve ratio. In the example we just examined, reserve increased by $100 when the $100 in cash was deposited in bank and the amount of deposits increased by 500. Money multiplier in this case is 500 per 100 and it will be 5. Federal Reserve System and how it controls the money supply. Founded in 1913 by an act of Congress, the Fed is the central bank of the United States. The Fed is a complicated institution with many responsibilities, including the regulation and supervision of over 5,000 commercial banks. The United States is divided into 12 Federal Reserve districts, each with its own Federal Reserve Bank, and each carry out the rules, regulation, and function of the central system in their districts and report to the Board of Governors on local economies. The function of Fed is first for clearing interbank payment, and the second is for lender of last resort for banking system. How the Federal Reserve controls the money supply. There are 3 tools are available to the Fed for changing the money supply. The first is changing the required reserve ratio, and the second is changing the discount rate, and the third is engaging in open market operation. Okay, let's see the first tool, changing the required reserve ratio. In this case, the Fed tried to decrease the their required reserve ratio to the from 20% to 12.5%. Because the required reserve ratio decreased to 12.5%, the deposit will be increased $300 to become $800. So the bank can increase their loans to $700 from $400, and the money supply become increasing to $900, $100 for currency and $800 for deposit. And then let's move to the second tool, changing the discount rate. The higher discount rate, the higher cost of borrowing, and the less borrowing banks will want to do. And when the borrowing decrease, the money supply increase. Let's see the illustration. The Fed decreased the discount rate, and the bank will increase their borrowing. The increasing of their borrowing will be increased the bank reserve to Fed, and it means it will increase the loan. And increasing the loan means the increase in money supply. And the last tool is open market operation. By purchasing or selling government security to increase or decrease the money supply. In order to increase the money supply, the Fed will purchase the government security, and it will be increase the bank reserve to Fed. The increasing of bank reserve will affect the increasing of money supply. In order to decrease the money supply, the Fed will sell the government securities to the private, and it affects the decreasing of bank reserve to Fed. And the decreasing of bank reserve to Fed will affect the decreasing of money supply.
Okay, that's all. Hope you understand, and thanks to Mr. Oni Bintoro as my lecturer and all my friends in postgraduate program, and bye bye.